Hello, this is Nick with you, and we are gonna go over the April 26th week. This week's market have rallied and have not given way because of the dual Bessent and Waller put. However, it is important to note that neither of the individuals is the final decision maker in either the government or the Federal Reserve. There was also news from the usual people familiar with the matter that the two biggest economies in the world are going to exempt a wide spectrum of goods from tariffs. We hold our view that when it comes to national security in the long run and economic prosperity in the short run, the states will pursue the former over the latter. This assumption also implies that the US will reach more robust deals with its allies in Asia faster than it's gonna reach deals with its allies in Europe. The Trump administration this week has ruled out a tax hike on wealthy individuals and any cuts to government transfer payments. And given these, at the moment, only a decrease in yields will lower the federal budget deficit. Currently, the decrease in energy prices is demand stimulative, which is the first part of the economy. The signal coming out of OPEC is an increase in production, and given that they have large spare capacity, this increase is easily achievable. The Trump administration is also making it easier for the energy producers to operate, but especially when it comes to the shale producers in the US, this increase in energy supply will mean that their bottom line will get squeezed. A deal between Russia and the US seems to be far away presently, and when it comes to Iran, the US administration is moving fast with reaching a nuclear deal. If a deal is not reached, it will cause further tensions in the oil rich Middle East, which is not constructive for the global economy. Now, moving to the par rate, as you can see, we had a decrease in the capital side of the things as opposed to the money market, and you have more inversion between the capital market and money market spread, but you had more steepness in the capital market spreads itself. And as you can see, we started the year with 61 basis points here. Now we are sitting at 100 basis points. And let's see where it's gonna go. At the moment, given the budget deficits that the US administration faces, and the fact that the Fed is gonna lower the rates, at least for the end of the year, you ought to see more steepness in the curve. This week, the real yields came down considerably. You had the 5 year coming down 13 basis points, but the break even rates were higher. And as we can see in the future pages, the people are preferring tips over the vanilla treasury. The reason why is because if you're going to get a stagflationary environment, that you have inflation and you have lower economic activity, the market wants the Fed is gonna lower the rates. You are gonna get duration from that, but then you are gonna have lower rates for the rest of the terms. Now I would say the best place to be is tips, because if the rates are gonna come down, you are gonna see that's gonna affect tips as well, but also because of the inflation part, you are gonna see the upside as well. So that was the reason that the real yields are coming down and the break-even rates are going up. Mortgage rates down 9 basis points on the 15 year, but it is still high. And as we will see in the future pages, the real estate sector didn't rally that much this week, and if they don't manage to bring it down, then you are not gonna see any meaningful activity in the housing sector. And moving to reverse repo rate, on average, we had an increase of $53 billion this week. So more banks have parked the money. Some say it could be due to because this is a tax season, but let's see what the next week data is gonna show to us. Okay, price levels. Again, break-even rates. It's higher, and it shows that the market anticipates that the inflation is gonna be like higher than the target at least. That's for sure. And maybe like sitting around 2.5 or 2.3 for the 5 year. Inflation nowcast. The direction. I'm going to repeat that again. We don't look at it as an accurate prediction, but its direction of change shows us what they believe is the direction of the prices. And as we can see, for the month of April, the headline is coming down, but not the core. And again, the reason that the headline is coming down because energy prices are coming down, that's going to impact the headline. But in core, you have things that it's going to take time in order to reshore them to the United States. And if you're going to have 10% tariffs, which is our assumption here, that if you're going to have a 10% tariffs for some time on the goods coming to your country, then you're going to for sure have higher core inflation for longer. So it's going to be more sticky. This week, gasoline prices came down, but only 3 cents, but the supply was higher. So on the demand side, the consumer is doing good this week also, but let's see where the data is going to take us. Copper, we need to consider that dollar was up this week. And even the dollar was up, copper was up. So as of now, the consumer is not doing bad. So let's see in the next month, especially at the end of the May, end of the June, what's going to be the prices in order to see where the inflation is going. Natural gas prices. When we have like a change in weather, natural gas prices are going to change for sure, but like compared to last year, it's higher. So, and one of the main reasons is that because you have more demand, especially when it comes to data centers and AI, and like the training takes up so much energy. And like the most of the gas that you get in the Permian Basin is associated wells. And if the crude oil prices come down, then you are going to have lower supply of gas, but not at Waha. At Waha Hub, there was a pent up, like there is so much supply that there is not enough pipeline to take it. So that's good when it comes to natural gas. But I believe like the prices are going to stay elevated for the near future. And the Bloomberg Commodity Index was down this week. Okay, now we are gonna analyze two countries that are so important for the global economy. First, we are gonna start with Iran. So right now, as you know, we have a nuclear. So we have Iran. So they have nuclear enrichment program, and which the U.S. wants to like have them to change the program so it would be more peaceful, as commentators put it. So we don't care about the politics that much here, but it's gonna affect the economy. So we are gonna go over it. So as you can see here that you have Iran, the oil producing part of Iran is here. For Saudi Arabia, it's also here. And you have Qatar and you have Oman. So you see like they see Middle East is oil rich, but like this whole region, they called it Middle East. But only the oil rich part is here. Because, for example, you have Egypt. They have gas, but they don't have oil. And you have Iraq here as well. So you see, like, this part around Persian Gulf is really oil rich. And here you have the Hormuz Strait, which about 20% of the global oil supply goes through. In case that the tensions rise, and let's say they go after the nuclear facilities in the worst case scenario, that we don't put that much probability to it, then the Iranians are going to retaliate against the oil fields here, which have like easily accessible to their weapon systems, and you're going to have them try to close the Hormuz Strait. And you see, Hormuz Strait has two sides to it. The shallow part is on the UAE side, so like the big tankers have to move closer to Iran in order to pass Hormuz Strait, and it's not going to be that good for the global economy, like, because in the case of Russia-Ukraine conflict, oil prices jumped, but like the oil supply itself wasn't affected. But here, in case of a real tension, in case of if you go up the escalation ladder, you're gonna have a scenario that for the first time in the history of oil, the oil supply itself is gonna get affected severely, and that's gonna be very bad for the global economy. So we need to pay attention there. If we take pricing as a prediction here, and like also you have poly market that you can check, but the Iranian rial had appreciated 20% against US dollars, like in April, just April, and that's a good indicator that things are going well. But we need to wait at least like until October to see where it's gonna take us, because after October, I would say there is a real chance if they don't reach a deal that we are gonna go up the escalation ladder. Moving on, China. So China is the second biggest economy in the world, but the whole region that we are gonna focus right now is the East Asia. So, like, US has now tariffs on even its allies like South Korea, on Japan, and Vietnam. And then you have like countries like Philippines. But moving forward, we believe that they're gonna put more focus on China in order to contain China's rise. Because as I said, like, even if you read Wealth of Nations by Adam Smith, in there it says like the first function of a government is to provide security. And like it was the case always in history that the governments also, like, they always pursued security over economic prosperity. Having said that, if we go to history, you had four peer competitors to US order in the world that are now not there anymore. So the first one was Imperial Germany. Then you have Imperial Japan. Then you have Nazi Germany. And you have Soviet Union for the fourth country. And in each of these cases, the US moved to contain them and roll them back. So I believe that when it comes to China, it's going to be the policy that the United States is going to follow. If it's going to achieve it or not is another question. But what is important for us that the tariffs, not at these levels, but they're gonna stay at a elevated level for the foreseeable future. But when it comes to Vietnam, Japan, South Korea, and Philippines, I believe that they're gonna reach a good deal as opposed to the European Union. So I would like bet that they're gonna reach a good deal here. But we need to keep these in mind. So let's move on. Garment credit. So this week, as you can see, if you held 1 to 3 year tips, you had a total return of 0.37 as opposed to 0.14% on the vanilla treasury. And as you can see, tips did better than treasury itself. So I believe that if we are gonna go into a stagflationary environment, that market is gonna adjust itself right now for that environment and regime. So I would go overweight on tips and underweight on treasury. I'm not gonna go, especially with the treasury. I'm not gonna go like to the 20 years like TLT and those stuff right now because you have too much uncertainty, and it could be the case that the rates are gonna drop further. I would go over to like TLT or like to 10 to 20 year when we have more clarity on the budget deficit. If they can rein it down and have control over it, then I would be more comfortable going there. But other than that, it's gonna be a bit hard. Corporate credit. Option adjusted spreads dropped 76 basis points on the triple C and lower, which is a good sign of like market, especially the bond vigilantes as they put them, are pricing in that we are not gonna go to that severe like recession, and you had seen the U-turn from the U.S. administration. Like the U.S. president came and said, "I never said that we are gonna like oust Jeremy Powell." That was interesting, and like the way that they operate is that they put the idea out there and like they make mess out of it, as I would put it, to see what policy that they are gonna land on. But looking at the spreads right now is better. So I would say like we need to look at the numbers and not less. You need to have an eye on the White House for sure, but then you need to develop a strategy for the long run that can make you money and have your wealth grow over time. So for the future, I would say, like for the short run, I would say being in the short end of the curve and being in high quality is the best that you can get here. Okay, on the fiscal side, so the deficit year to date, year over year, it had increased over 12%, which is higher than inflation. Like any measure that you want to use, it's not more than like 3.5%, even if you use producers price index. So like we have a real problem here with the deficit, and it could be the case that if they increase the debt limit further and further again, that they're going to get another rate cut from S&P, followed by Moody's, followed by Fitch. But the most interesting thing is the impact of tariffs. As you can see here, this line, it shows year to date, year over year, and here it's 25th. Tariffs had resulted in 13 billion more in revenue for the government, which is not that much. It's not going to move the needle. And if you're going to have drop in the receipts, that's not going to be good for the economies, because when you put tariffs, the other countries are going to retaliate, and then your sales are gonna drop. So I think like they need to reach deals with their allies faster. But in the long run, it could be the case that even if this administration is not very keen on like doing free trade with its allies, then you have the mid elections, the midterm elections, then you have the presidency in 4 years. Then it's not gonna be the case that the next administration is saying for sure we are gonna follow their previous administration. When it comes to China, the Democrats and Republicans follow the same playbook. But when it comes to allies, I would say like you can get a real change in the next presidency. And like I know it's 4 years away, but like the companies when they want to set up their supply chain, they are not gonna wait like 3 months to decide. They are gonna wait and see in order to do big commitments. And it's interesting. If we go over the presidency after Obama, you had Obama here, you had Trump, followed by Biden, followed by Trump. And you see, like, at each turn, people voted someone in, and then in the next election, they decided to go to the other party because they weren't happy with the results. So let's see if they do poorly in this administration again, then the people are gonna vote the opposition in. Labor conditions. This week we only had the initial claims and the continued claims. Initial claims went up by 6,000, but then the good news was that you had the continued claims come down. And I say like you are in a restructuring environment. And you are not seeing a recessionary environment as of now. If you go over the ISM reports and like the soft data, you see they are having soft hiring freezes. They used to call it hiring freeze, but now they're using this soft. So they won't just wait and see because the economy is doing good. The demand is there. The consumer is spending in a way that there is no future, to be honest with you. But they have a soft hiring freeze to see where we are gonna land on. And when it comes to ADP report, we are gonna have it next week. So let's see what's gonna be the jobs added in April. Consumer and sales. This week we didn't have any change to our tables except for the April numbers that we got. We had the upward revision for consumer sentiment, but it's lower than the last month, than March. And then you have a downward revision for inflation expectations. And you see like the break even was at 2.3, something like that, for the 5 year. But then you have like this disconnectness with the Michigan 1 year inflation expectation, which sits at 6.5. And the reason is because that Michigan uses surveys to reach its inflation expectations. So it goes to the people and says, okay, what do you think is going to be the inflation for the next year? And you need to be careful with that. It's not going to be accurate for sure, but the thing that it's going to show is that, okay, consumer is saying that the prices are going to go up. So they're going to follow two strategies here. They are going to increase some of them, they are going to increase their discretionary, like big items, like maybe cars and those things, before the inflation hit. So you have forward pulling. And on the other hand, you have some consumers that are not that gonna increase their saving in anticipation of increasing prices. So I would say, like in the short run, right now, we are gonna see maybe like the sales of some of the discussion, especially when it comes to auto. It's gonna go up, but let's see what's gonna be the sentiment in 2 months' time, especially in mid in the in summer. PMI, we are gonna get it. We haven't received the one for this week, for April, but as I said, services is very important for the how the economy is doing right now. But then over the long run, if you want to do investments in the manufacturing side of the things, like going for the autos and like everything, you need to look at manufacturing because I would bet that the big manufacturers are gonna wait and see where the administration is gonna go, and you're not gonna see much improvement in manufacturing right now. But services, if you see more deterioration in services, then you're gonna face a problem, and then you're gonna have the have a deeper recession. Factor performance this week. Low volatility was down because the market had a risk on approach to the market, and growth and momentum outperformed, especially in the large. And S&P did increase 4.59%. And the reason was because of, as I said, like was because of because of Waller and Bessent put, but they are not the final decision makers, and we need to pay attention to the final decision makers. Moving on to the sector performance, consumer staples down. As I said, like this is not a rally. I would put it. It's not a rally. It's a rebound. And because like they are seeing a more non-belligerent tone coming out of the White House, especially towards the Fed, especially towards like the allies. So we are, and like they're like putting out numbers of how many countries that we are gonna reach a deal with, but we are not there yet. And you see, real estate didn't ride the wave this week, and the mortgage rates are high. If they don't come down, the real estate is not gonna do good. But you need to separate REITs from the home builders, and we are gonna analyze them in the coming weeks. Because if you have the housing prices go up, then the firms that have that rent properties, they are gonna have a better bottom line, but not the home builders, because you are not gonna have so many buyers in the market. And tech had outperformed the market, so it shows it's like a rebound. Moving on to the industries, on the industry side, you have the semiconductors outperforming all other industries. And the problem here, I would put it, is that in your on the semiconductors you have Nvidia, but the problem is they are pricing the AI, and like going back to other technologies that were like general purpose, like internet. Now, one of the Magnificent Seven companies, Amazon. And it uses internet heavily. It's based on internet, but it didn't invent it itself. So it shows that okay, you are gonna have AI. The semiconductors are gonna have more cells, that's for sure. But then you are gonna have competition, and when you are gonna have competition, it's gonna squeeze your margins and bottom line. So for the long run, you need to check what's gonna be the total market size. In the future, we are gonna do that. Given this market capitalization, I don't believe that you are gonna have that much demand in the market in the long run, and the margins are gonna squeeze. Nvidia is gonna make good money for now, but then especially when you have the curbs against China. China is the second largest economy in the world. I don't see how they're pricing in that much like increase in sales. And like then you're gonna get competition. So these are the things that you need to look out for. And going on to the oil and gas, I look at them as like a leading indicator. You had the OPEC increasing its supply, so it shows that oil and gas E&P in the US is not gonna be the leading indicator that used to be that much. And like given these prices, you are not gonna see that much capex. And as you can see, the relationship is changing. So your capex, so equipment and services is your capex here. They have not rallied that much. Like they stayed flat. And moving forward, I believe that if OPEC increases its prices, then you are gonna have more flat capex. Okay, and here you have the ETFs, and like there are like some different industries in here. The most interesting thing was clean energy. It's rallied 9%. Not sure the reason why, but clean energy, like there used to be a hype around it, especially during COVID. But right now, clean energy, especially in other countries that are not energy independent, translates into energy security, especially in Europe. They see clean energy like solar and like these energy resources as energy security. But then again, because they have an intermittent nature, they are not going to rely on it totally. But like 9% rally, it could be only due to people being long on the market. Moving to the commodities. Again, we need to consider the performance of dollar. It had appreciated this week, and considering that, we are gonna look at WTI down, gold down, because we have lower risk in the system right now, but like year to date, it's up 24%. So it's still elevated, and I don't think it's gonna come down further. We have lithium, it's coming down. Moving on to soybeans, it could be due to like saying that we are like negotiating with China. Also, like the US administration said, we are gonna bail out the farmers. Soybean had rallied, and you had live cattle. The only commodities that goes up no matter what happens is live cattle. And when it comes to food, if this you have this like trajectory, and you have like other like commodity prices go up as well, like when it comes to food, then you're gonna face a problem in food as well. But right now, wheat is down year over year, but like corn is up, and like it's interesting to know that like you use corn also in order to feed live cattle. So it could be one of the reasons that the price of like live cattle is up. Asset class performance. So this week, Latin America outperformed. Reshoring, it could be the reason. It could be the reason. EAFE. So it usually the developed countries, ex-US. It did go good, and year over year it did 11%. Interesting. China. Year over year 25%. This week up 3.5%. And year over year, like China is doing good. Like in the short run, like I'm not pretty sure how much the tariffs are gonna have an impact on China, because you see, like in the long run, the economy is the product of population multiplied by GDP per capita, or we can say here quality. And because of investment in education and infrastructure, the Chinese economy is gonna do good in the long run. That is the belief that we have, but not in the short run. So tactically, we are not in the Chinese side of the things, but in the long run, especially in the main, like in the companies that are set for growth, they are done. They are gonna do a good job. And as I told you, US dollar appreciated, 0.21. Japan went up, and Russell 200 also up by 4.1%. Let's see what next week, and especially we need to wait for the end of May in order to have a clear picture of where things are going. So let's wait for that China performance and Latin America performance. Risk level. So I have the VIX futures here. You see the VIX futures came down notably, but they are still elevated. They are still elevated, and like like the theme in this administration is uncertainty, I would say, and the volatility is the name of the game, as so many commentators put it. When we go to dispersion, it's at 34.6. It's still elevated, but lower than previous week. So, like, market is repositioning itself, and I believe, like, especially when it comes to low volatility, you are gonna have players that are gonna position themselves for the low volatility stack. So no matter what happens, they are gonna get their growth and their capital appreciation. And like also you get the dividends. So like you need to pay more attention here, because if you follow every wave that goes up and down, and like it's not gonna be good for your capital appreciation at the end of the year. So that's one of the reasons I'm overweight low volatility, no matter what happens, because you can have the risk levels come down this week to only go up by a tweet or by like a truth, as they put it, next week. Okay, as always, going to the oil demand and supply, because we look at it as a leading indicator, because energy is the first part of the economy. So, oil and gas producers all over the world up, Russia again up, these are in US dollars, and Saudi Arabia is up, but not that by that much. The reason why? Risk that the risk that they are facing in Middle East. And you had this huge explosion in the Iranian port. It was one of their biggest ports, and like you have the escalation and like tensions there. So you need to be careful. So, and like the market is pricing that in. WTI down. So because WTI was down, you had the increase in production by these two. The Russia has the prospects of like reaching a deal in future, but not right now. Aramco is increasing its production and also they are moving into refineries. So they are becoming more of a downstream, increasing their value proposition. But all in all, the reason that they rallied was a decrease in VIX, so their denominator, their cost of capital went down. So that's the reason that you see like the oil and gas producers went up. But going to the physical data, gasoline, it went up weekly by 900,000 barrels, and it's up year over year. And the stock went down by 4 million barrels, and its production is up. So given that, like, consumer is doing good, like there is a demand for gasoline, that's good. But moving to distilled, you had a drop in production, but at the same time you had a drop in the stock, and the supply remained flat. And here you use the distilled in more like um, manufacturing side of the things, as opposed to like being used by the consumer itself. Crude oil production flat, and refinery crude input, as it was obvious with the case with the gasoline, up 400,000, and capacity utilization is up, but then like year over year it's down. Okay, so these were the data for this week, and next week we are gonna wait and see where we are at with the tariffs and what's gonna be their structure. I'm not sure we are gonna get more clarity, and you have the Federal Reserves coming up in 2 weeks, FOMC meeting, and I don't believe you're gonna get a cut there. So let's wait and see where the data is gonna take us. Now the consumer is doing good as of now. Some companies have are having like soft hiring freezes, but it doesn't mean that they are not gonna hire after they get clarity, because as you can see, the consumer is doing good. And if they reach a deal with Iran, you are gonna have more oil supply in the market, because OPEC, Iran is exempt from the like the quota system, so from the quote system, and that's the reason, because they said we were under sanctions, so we didn't have that much production, and the facilities are old, so there's a good chance that they are gonna reach a deal. But if not, it's gonna be demand structuring, because you're gonna have high oil prices, and you're gonna get a slower global economy growth. So that is really defining. The chances of that happening is low, but the consequences is so high that you need to pay attention to it. And when it comes to China, we believe that the tariffs are going to remain elevated. These levels are so high, so you're going to get some kind of concessions in form of carve-outs. That the end result is going to be a lower effective tariff rate. Okay, have a good week.